All right. Good morning, everybody. Short day on a short week. Be mindful the market closes at 1 o'clock. Don't get caught. They're going to try to tuck in the news for Friday into today. They are working on getting the bill passed early this morning. Some analysts have said they're really concerned that the bill is going to pass at 8:30 when we get non-farm payrolls. So, like a double whammy on that one. Markets are basically flat around the world, waiting for the bill to pass and having a critical eye on the employment numbers. There's a critical level that economists have kind of highlighted over the years 262, 263. It's a line in the sand that historically, once crossed, puts us into recession forecasts, uh, stagflation. Nothing good comes out of that, and the projection is 240. So if this number comes in the other way around, say 232 instead of 240, going 4,000 in the other direction, I think the markets are going to react to that. If it comes in line, they've already priced that number in, so likely won't see uh, much change there. A little wider of a number is the employment report, 140 versus 110. So we'll see what the employment report has to say. And creeping up into 4.3 on the unemployment rate. That's about what we have heard most analysts talk about. Getting above 4.3, getting rounded into 4.4. That again has echoes and connotations of either stagflation or recession. And looking at the Fed Watch, September, is where everybody thinks we're going to finally come to a head, right? If I think Finance Juice was showing a 75% chance of a rate cut by September, which is just a lot of wishful thinking on the markets. Yeah, 71, basically 71 and a half right now. This is at some point going to be an issue, right? Because if they're right, that means there's enough economic data to show that things are deteriorating badly, and the Fed is going to step in and try to intervene. So the PAL put, save a hoe, plunge protection team, use whatever fits. On the other hand, they've been projecting that these tariffs were going to be bad all year. We heard about it in January. We heard about it in February, in March, April, and they just keep kicking the can down the road for, it's going to be bad next month. It's going to be bad next quarter. Maybe. So far, not yet. And if that turns out to continue to be true, this is going to need to be unwound. That is certainly going to take some of the juice out of this market. The listening to Bloomberg this morning, they were cracking jokes about how the fund managers were getting it all wrong and were heavy short, trying to cover their shorts in this last quarter's end, which is funny because we were talking about that short covering rally that we saw the other day, and there was window dressing and just into quarter shenanigans. They got it wrong, and they've been getting it wrong for a while now. So what it's going to look like when they begin to unwind this rate cut, we'll have to, wait and see how it plays out. But the UK's up nearly 0.5%. Everything else is basically flat, up or down, less or around 0.25%. And we wait. 10 a.m. is going to be the big one after 8:30. and likely the last one. The Bostic speech, not really expecting anything out of this. They've been beating the same drums, singing from the same book. What they gonna say now that we haven't already heard? You know, it's gonna be just more of the same. We got some auctions in the front end today at 11:30. That'll be the cap, but you could probably just use the IRX since these are so close to the front end. And that'll wrap us up, because with that short day, just like the FOMC minutes, we're getting ECB minutes, right? Same thing, just in a different nation. Doesn't look like anything really surprising came out there either. The put wall was rolled down significantly. 55.50, right? Remember, we were able to see the put wall yesterday when we were just looking at say a 5-day chart. Now we can't see it. We got to scrunch everything together. Oh, hey, there it is, all the way down there. That's a very negative bias, right? When you see behaviors that you can consider, you know, passive, non-violent, peaceful, this is a very bearish behavior to see this. Very bearish posture. Rolling that put wall out of the way is like knowing you're going to pick up something heavy like a couch, and you clear the space between you and wherever you're going so that you don't trip on anything. They just got the put wall out of the way, getting ready to do some heavy lifting. Maybe it's perspective. Sure seems like that zero gamma line's a lot closer than where it was yesterday. I'm going to have to revisit the spot gamma page and run the projection and see if they moved that thing down. They did not. So it's just a perspective. We're still riding well above the 4-period daily moving average. If we break to the downside today, 62.57 is the line in the sand that we've got to get across. Focus on where we are with VWAP for the first part of this morning. Just remember at 8:30, we're going to start getting data. So right now, this is the box GTFO. Break through this red line, which is just one of the options levels from spot gamma. And then we can focus on the 4-period, which is really close to yesterday's halfback, depending on if you use the RTH or not. So there's the RTH, and you can see the halfback lines up right on that 4-period daily moving average. It's not a coincidence, right? When it comes to pivot points, what you're going to find is when you're tracking them correctly, they overlap other important pivot points quite often. Points of control, halfback levels, cog lines, previous day's high, low, previous day midpoint. The way it goes. If we do all of yesterday, then the halfback is just slightly below the 4-period. Running a little light in the volume, which makes perfect sense for a short week like this. Really, all things considered, for a short day on a short week, that's kind of impressive volume. I know 40,000 on any other week, we'd be looking at that number saying that's coming in a bit light. But given the circumstances, I'm kind of impressed. They were expecting, I think the number was 79 uh, on the travel scale, the number of people expected to, and I think they were talking about drivers expecting to travel more than 50 miles this holiday weekend. Pretty impressive. So we got the average daily range running at around 65 points. It is as small as it's been in a long time. Since we're basically flat, there's no edge towards one end or the other here. We do have a market maker move this morning. Now, if you don't have Thinkorswim and you don't have a market maker move, as long as you have an options tab, you can take that route, right? So go into the options tab and look at the implied volatility average, which is generally on the right-hand side of most brokers. If it's not there, I've seen some brokers that have it in the middle between their call wall and their put wall. But you want to look at the front end of the implied volatility average and compare it to the next series out. If the front end has a higher number than the next series out, you've got a market maker move. Thinkorswim made it up, right? So if you don't have it, if you don't have this platform, you're not going to have that. So you can just find it on your own. There are articles about it that Thinkorswim had wrote over the years. Schwab owns this platform now, so you'd have to go to the Schwab website, but you don't need an account to read the article, right? You can just Google the article, market maker move. They never mention futures. I just adapted it myself over the years. Why do we care? The market maker move tells us that they are applying additional hedging this morning. Now, look, they're always hedged, right? It's not like they just woke up this morning and decided they need to put some hedges on. They are always hedged. But this is extra hedging, kind of like having homeowners insurance, seeing a wildfire and calling up your insurance agent saying, you know what, I really would like some extra fire insurance. Why not? Right? You can see a wildfire headed towards your house. Why not pick up some extra fire insurance above and beyond the insurance that you already have? Of course, they won't let you do that, right? But this is trading, not dealing with your house. So they are getting this extra insurance because they see something today that is causing them to worry. And this is just for today. It will expire by the end of the day, whether they like it or not. It has a shelf life to it. So they're spending money that they can't get back, right? This isn't like a trade that you or I would put on. This is turning on the fireplace and throwing bundles of cash into it. You're not getting it back. And they still are more willing to do that than to go without it. That should give you pause because they are concerned about what's going to happen in the next hour. I'm making the assumption that it's the 8:30 data that they're concerned with. We'll know I'm wrong if we get past 8:30 and that number does not decrease and instead either stays where it is or goes up even more. Then we'll know that it's the 10 a.m. data. Either way, at some point today, the balance of time is going to weigh on this thing, right? Here's the end of the day. This is where we are now. That thing can increase, but at some point, time's going to kick in and the value of that thing is going to decrease because, well, by the end of the day, it's going to be worth zero, right? It won't have any theta left in it, no matter how much they trade it. So, it's either going to end up in the money or it's going to turn to zero. There's their hedging right there, 6,200, 62.25, and then they got a little bit right up front here, but really it's back here. It's the out of the money options that change the implied volatility average the most. This number is a proprietary number. Each broker has a different little formula that they use, but we know some of the components. Some of the components is the out of the money options implied volatility, which is this column right here. Some of it has to do with the time, and then they take the square root of time by the implied volatility average by the volume traded and the pace of the volume traded. And it gets a little more complicated after that. Doesn't matter, right? We don't need to recreate the implied volatility average here. We just need to understand why that number is increasing or decreasing. These trades that they put on this morning out of the money came in at a pace quick enough to increase the implied volatility average in the front end. That gave us the market maker move. That was our heads up. So at 8:30, we're very likely going to get a liquidity gap bar. We'll deal with that. GTFO the range if we can, and then we'll just hold the line, wait for data, go into the end of the week. It's worth noting we can hit the lower ADR today without leaving yesterday's range. If we want to hit the upper edge, we've got to break back outside of yesterday's range, break our own Globex high, then run up there and get it done. It's also into the 3863 area. I don't know where it got 38 from. Into the 6300 area. So we'd have to get through the 92 cog line, 63 flat, and then into 6308. The purple line here is a floor pivot. It's just your standard, average, normal, everyday floor pivot. I put a channel around it. Those are called CPRs, central pivot ranges. There's a basic formula if you've read, the pivot book that gives you the math formula to generate the channel. We use this channel for kind of a gauge on what to expect out of price today. If we break out, what should price do? And with a very narrow channel, the implication is, well, if we break out, it's likely that we'll just keep running. And a really wide channel implies if we break out, that the breakout will fail and that we'll come back in again. Now, these pivot point channels don't make price do anything. It doesn't make us break out. It doesn't stop us from breaking out. We had a really narrow channel back on Tuesday. We never broke out, so we never got to see, is it really going to run or is it going to come back in again? Today, we already have broke out of yesterday's range, and well, so far it didn't stick, and we're still chopping around sideways, basically in our own IB. We do have an MDP this morning. That's a missed daily pivot. It's exactly like it sounds. We have a daily pivot and we haven't hit it yet. Therefore, we've missed it. It won't count, though, until the end of the day, so we have to make it through the entire day without hitting it. We would count that for Monday at this point as a missed daily pivot. If we continue the drive to the upside, 6292, imagine that, is the R1, which happens to also be a cog line. And to the downside, S1 is at 6250, which is the big options level. Unless the news really kicks up some steam today, that's very likely our range. 6292 cog line down to 6250 options level, playing the pivot point as the central range to turn back and forth from. Your eyes don't deceive you. The green line is closer to the pivot than the red line. It's all a matter of math, right? There's a little bit of a tell in that, by the way, when one edge is closer to the other. But right now, that tell goes counter to the put wall being rolled down. So they kind of cancel each other out. Boy, that's a very narrow distribution. So there we are. 6242, which happens to be an old school cog line that I don't mark anymore. but it still has relevance. Obviously, it's where this week's point of control is. We got a pretty solid distribution. We're outside of the value area, and we're in the thin stuff up here. We're not really putting in a footprint at this point. And we're putting in a lot of time up here, but not a lot of work is showing up. If we do move to the downside, you can see that once we get through 6250, we've got the week's point of control down there, and that's very likely going to be a drag on the move. So we could go lower than that. It would just take some effort to get through there. It gets shallow under that level, and we can get to 6150 relatively quick. You guys remember 6 weeks or 8 weeks ago when I laid out that map of how, I guess it was longer than that, right? Because it was the fall down. I laid out the map of 50s and 100s on the ES, where every one of these markers was another 100 jump and another 100 jump, and it was lining up with the profiles really well. I think the video series, the morning briefing, would have been probably the March time frame we talked about it, maybe early April. Yeah, I think that sounds right. Last week in March, first week of April, we had this talk, and I tracked it back to the highs, right? So this entire run, the lift up and then the next drop down, all of it was lining up on hundreds on the ES pivot structure. If everything begins to unwind and we start dropping, that's the target goal, right? 100 and then pause for digestion, and then another 100, and then a pause, and then another 100, and then a pause, maybe even a lift up, right? Where we lift up like 50 and then we drop another 100. And it makes sense, right? Because that's generally what price does, is something like that, right? There's your hundreds in the drop, and there's your 50 on the pullback, and then another 100. What's the old phrase? 2 steps forward, 1 step back. Get the idea, right? We're not there yet, though, right? We continue to not fall. The markets just hold the line, hold the line. Speaking of the line, we've got the point of control from the TPO and the point of control from the volume profile now finally lined up. But we've got the entire zone as the value area. That is absolutely worthless. Worthless. It's like using a flashlight outside in the sun. That's not going to be helpful, right? So this really wide value area does nothing for us. Maybe after Monday afternoon, right? It'll start to shrink up a bit. This would be Monday afternoon right there. The lower edge isn't even here anymore, right? And it's very likely that we're going to see the value area end up either somewhere there or there, because it won't even care about that, right? At that point, we're going to have like a 50-point value area across this upper zone. But we're talking next week sometime. For today, this isn't going to give us anything of value. If we do break down, though, back into 6250, you can see that's the structure over the last 10 days, and is the level we've got to get through. We're getting a lot of trades in here, which is what we're seeing on the TPO, but the volume's coming in a little light, all things considered. No new VPOC today. And looking at the distribution from yesterday compared to today, this is a really nice classic distribution. Hold the line and wait. We got a little discrepancy between these two with the TPO and the volume profiles point of control. And you can start to see the double distribution that was built up in here, but they're so close together with just this little valley between them that you're better off just encompassing the whole thing as a single distribution. And we are still inside the range for the week. The top edge of the range was 63.09. We've got until 1 o'clock today to hit that. Even if we hit it, we can expand outside of it. We just need to close today inside the box. Our track record right now for closing inside the box is horrible. It's supposed to be 7 out of 10, and that's just some easy math for 70%. So you should be able to count back 10 weeks and see that Friday's close is inside this range 7 out of 10 times. The S&P, however, has a very accurate expected move model, and in decent times when things are running normal, it can close 8 out of 10 weeks inside the box. We haven't hit that standard of 70% most of the year, right? We've been closing outside of the box consistently for most of the year. So the expected move model for how far can price go, iron condors, broken wing butterflies, all that sort of stuff, they haven't been functioning very well when it comes to using implied vol to calibrate your targets or your distance, because we've been exceeding the levels consistently over and over and over again. 1 week of closing inside the box doesn't change that. We need consecutive weeks closed inside the box on Friday. So it looks like we may get to restart the counter here, right? We certainly didn't do it last week. We closed outside the box. So maybe this will be the start, right? Week 1, get the count all over again. We're still above the 10-day. We're not extreme. We're not quite back within the 1% range. It'd be better if we were just a little lower, say down in this zone, but we're really close to it, so it's close enough. This is showing that we're not in an extreme condition. We're not, exaggerated in an overbought state. It doesn't owe us any sort of mean reversion or pullback, least squared method, nothing like that. From this perspective, we're, cruising along just fine with no threat to how far we've come. Now, looking at the weekly, we're still running at 4.8%. And sure, we've been higher than this before, but generally speaking, we're kind of at that level where we expect either a pause or a reversal. Because on the higher time frame on the weekly, we kind of went too far. I don't like using the phrase overbought. Gives newer traders the wrong impression of what price should do next. So let's just not use that. But we have run a long way, and we did it a little too quick. So we need to take a pause, and we need a correction. We can have a correction in time, which means we just sit sideways here and we let the 10-week come to us. Or we can have a correction in price, which means we turn around and we head back towards the 10. One of those two are going to happen. The question is, which one's it going to be? If we sit sideways and let the 10 come to us, then this indicator will slowly work its way back down. If it's the other way around and we take the express route, then it's going to be because we turned and went back towards the 10. We've certainly had examples of that in the past where we just drop and we get there really quick. Examples here. So it happens. Either way, a correction is coming. We just don't know which one of those two it's going to be. Nothing wrong with a pause, right? If you consider the run that we had and the idea that we kind of need one. Lots of examples on what to anticipate after that run. A little bit of a digestion before another run. Maybe a little longer of a digestion with higher lows and equal highs. So if we pause and wait, it'll look like that. If we turn and move back towards the 10, the easiest way to visualize that would be to just put the 10-week on your chart and see where the heck it is. So on my charts, the blue line down here is the 10-week. I've got the EMA and the SMA on here, which is why there's two blue lines. I don't care which one you use, pick one. You'll notice they're really close together. They're both at about 6,000. that's the mean right now, or the average price, or if you want to use, fun words, you can say it's fair price. It's at 6,000. We're at 6,280. What's 300 points among friends, right? So if we do begin to correct, you know where we're headed, back to the mean, back to 6,000. China was hitting headlines this morning. They're down, and gold miners are off the mark, but they're not down enough. We want these down at least 0.5%, and it's not there, but it's in the right direction. Same thing with uranium, down, but not down enough. And looking at what's up, we've got quantum, and really, that's it. I mean, we got solar too, but nobody cares about solar. You don't want solar trying to run the bullish or bearish bias on the day, right? It's not that nobody cares about solar, just that you don't want a rally day based on solar or pot stocks. Let's hope that don't break something. Hey. Has a really big head and shoulders on IWM. I mean, just a massive inverse head and shoulders, which is a little bit of a joke anyways, but I mean, it can still get back up into that 230 level in time eventually. The problem with this thing is it always runs too fast and ends up, tripping over its own feet, like that toddler in The Simpsons that makes 3 steps and falls down. So things that are running this morning: nat gas, small caps, silver, oddly, when we had gold miners down. Solar, pot stocks are in the right direction. They're just not there yet. China, more China, uranium, crude, and gold. So silver up, gold down. One of those is lying. We're going to see a correction in one of those two. The answer will very likely come from 10-year and dollar. All right, it's going to be swag levels today with these two. Keep your eye on how far they go, not necessarily what their number is. The 10-year we'd already discussed, 4.2 is just way too low. It needs to turn around. There is I'm going to use the word, but it doesn't really fit. There's a collar around the 10 years price. It's supposed to stay in a range, just like crude is supposed to stay in a range. We can expand beyond the range from time to time, but it's not supposed to stick, right? It's very likely that we mean revert and go back inside the range. And if we don't, we're going to break things. And we are there, right? We went to 4.2 plus a little extra. We need to get back above 4.3 into 4.4, 4.42, somewhere up in here. But we don't want to make really fast moves. The rate of change, how fast we get from point A to point B, oftentimes is more important than what the number is that we're at. So we don't want this going any lower. That's the main takeaway. We want it to hold the line and or begin to move its way back up. And yeah, that is a little itty bitty inverse head and shoulders, but head and shoulders are, the butt of all jokes when it comes to patterns and, reasons to trade. So don't get hung up on it. Same thing with the dollar. The administration has been working all year to get a lower dollar. Yay. They need to keep it since that's what they're trying to do. So any moves back up is going to go against that. You can see how we've consolidated, dropped, consolidated, dropped, consolidated. I mean, that's what price does, right? Expansion, contraction, expansion, contraction. So we've contracted, we consolidated. If I was to turn on the RSI Laguerre, this would show that we're building up energy for the next leg. It is worth noting that the legs are getting shorter. So we had that run, and then it was shorter with that run, and then it was shorter with that run. So this move is slowing down. There's also the distance of the other direction, how far we pull back. The pullbacks are getting farther. Then there's how long did we stay paused? We don't know how long this pause is going to last because we're still in the pause, but we're at least the same length of time that we were in this last one. We're already back above VWAP, so at this point you can run reciprocation. That is just a really fancy word that says whatever you got to the downside, take it now and set it to the upside at the breakout point. At the bare minimum, it owes you reciprocation. So there's the breakout point, 62.88-ish is the high side if we're going to reciprocate. Think of your jigsaw, right? You run a jigsaw, the blade moves X amount in one direction, then it gives you the same movement in the other direction. That's a reciprocating saw. We still have economic data coming, and that is the next piece. Get through that, and then 10 a.m. we have one more bit of data, and then just watch headlines because they were talking about that big bill and getting it through the House this morning. And as long as they don't make any changes, it doesn't need to go back to the Senate. It'll just go to the president. He'll sign it. Then that'll be that. Then everybody's going to be focused on tariffs. So right now we're split between the tariffs and the bill. Get one out of the way and we're going to have the other. That's what I got for you guys. Be careful, be safe. Short week. Don't lose any fingers. I'll see y'all next week.